And you know what that sound is. It means we are now live here on our YouTube channel. It's Tackle Trading's Halftime Report, our daily show where we go through the markets one step at a time, top-down analysis style, have a conversation, give you guys analysis, insight as to what is happening across financial markets from a chart perspective, news perspective, economic data, corporate information, anything grabbing our attention we think is important and relevant, and analyze it for you out there. Welcome back to our community. Hashtag Team Tackle right in the chat. Let's get it started. Lively, fun, and keep it engaging there today. And by the way, if you're a beginner, don't be intimidated by all our veterans. They won't bite you. Come on in and chat with them as well. Have a part of the conversation, right?
They might bite.
They might bite.
But it's a nibble.
Yeah, that's right. Yeah, they'll bring you in and definitely get you indoctrinated into tackle trading here as well. We got a fun show planned for you today. If you're brand new to our channel, we do this show each and every day whenever the markets go live, 12:30 p.m. Eastern. Click subscribe, click the bell, come back and join us. We got to digest what the Fed told us yesterday, look at the technical charts, kind of update some of that. That's really the major conversations in the market. Got Greg Old Money Holmes joining us as well. He's going to be giving us some of his dividend ideas, some value ideas later in the show.
I'm going to bring that old money mindset today.
Yeah,
I like it.
Some wisdom, Greg. I'm looking forward to it. Greg, how are you doing today?
I'm doing awesome, man. Thanks for asking. I'm happy to be here. I enjoy doing the halftime report with you fine fellas. It's always educational and fun at the same time. So
fantastic to have you as always. Matt, how you doing, sir?
I don't know how fun it is on Fed Day, but I do agree with the overall sentiment.
Yeah. Listen, the Federal Reserve came out and, they stroked our hair. They gave us a back rub. They tried to tell us everything we wanted to hear, that everything's going to be okay forever yesterday. We were sitting there watching the press conference yesterday. It was fascinating.
He tried not to say certain things, though.
He did.
He tried really hard. You got to give Powell a lot of credit. He tried really, really, really hard to dance around Operation Twist. He tried so hard. He was dancing and dancing and dancing. But unfortunately, his skill set was about the same as mine, and I only got the two-step, and he was not even good at that. So
the problem is he never said those three little words that everybody wants to hear. I'm for real.
No,
we did not. We don't necessarily believe what he has to say all the time.
No, and I'm not sure the bond market believed him either.
No. You know, you mentioned Operation Twist, Matt. It was so interesting. We were online after the halftime report yesterday. Coach Mark, who's here. Marky, I saw you pop in. Welcome, my friend. It's good to have you. You, me, Mark, Gino was there. A couple of the other coaches were sitting there watching this Fed presser, and there were several times a reporter would bring up the phrase Operation Twist in the question, and Chair Powell would not repeat those words in his answer.
No. In fact, he had a standard commentary over anything like that. Our projections are what our projections are, and we're going to be data driven. And it's like, you just don't want to say Operation Twist. You just have no desire to mention those two words. Like, they're just not gonna happen. But it was an interesting Fed meeting, and I thoroughly enjoyed, sitting on Zoom with the coaches of Tackle, having them listen to me overreact to every single thing Jay Powell had to say. Mm-hmm. No, I thoroughly enjoyed it. It was great fun discussing in real time, that type of commentary and the importance of that commentary with the team. It was a great day yesterday.
Mm-hmm. I
really enjoyed it.
Well, let's analyze it right now. Let's get right into it. What did the Fed say? What did we learn? What do we know? What is the impact on your thinking about markets? And let's start with you, Matt. I want to get everybody's take on this. Matt, Mark, Greg, myself. Let's have a conversation. What did we learn, Matt?
What did we learn? We learned the algorithms are still alive and well based on the price response to the numbers that came out yesterday. And that's kind of where I want to start with, because I think that's kind of the storyline here today is the revisions to their what is known as their SEP, but really what we're talking about is their guidance. Where do they believe the economy is going to be at the end of 2021, 2022, 2023? Where is their inflationary projections, and ultimately, what are they doing with their monetary policy, and what tools are they looking at their disposal to act in times of crisis? And their projections were quite amazing, quite frankly. A revision of U.S. GDP from 4.2% in December of last year. Now, this is all 2021 projections, okay? So in December of 2020 is when the last time we got the dot plot. So again, the dot plot happens every quarter. We get the Fed every 6 weeks. So we get them twice a quarter. We get the dot plot once a quarter. And in December, we had the revisions of US GDP of 2021 coming in at 4.2%. That were revised upwards to 6.5%. That is a massive revision on the economy. Now, it certainly fits the theme that's been happening since December: vaccine distribution, economy, opening back up, getting back to pre-COVID levels. This fits that theme. So we were all expecting an increase in GDP expectation, but 6.5, that's a pretty aggressive expectation for US GDP growth. And quite frankly, that's a historical number. Now, there's context. We're coming out of a pandemic, and obviously we got hit pretty hard. So the rebound's going to be fairly aggressive. But that's the highest GDP projection of US economic growth in how long?
Oh, I looked it up. Yeah, it's been at least like 40, 50 years
since the 80s.
that. Yeah.
So we're talking about a fairly sizable increase in GDP growth. And obviously the policies that have been put in place in the past year, both from a fiscal and a monetary stimulus perspective, is going to aid in that growth, but it's also going to aid in inflationary growth. And right now, we're currently projecting PCE growth of 2.2 to 2.4%. CPI report is expected to follow suit into that mid twos from an inflationary perspective. And so the revisions on both inflation and the revisions on GDP simply confirmed what we've been seeing in the marketplace, and that theme that's been developing in the market over the course of the last 3 months. Once again, economy getting back to pre-COVID levels based on the monetary and fiscal policy. Inflation is going to run a little bit hot. The Fed had already moved the goalposts from the inflationary mandate last year to average above 2%. So the 2.4% number it's a little scary, no doubt about that, but it's also not too surprising given the fact that the Fed did suggest this was going to happen, and they have stated that they will allow inflation to run hotter than the 2%, as that mandate is now an average of 2% instead of a hard line or a target to a certain extent at that 2%. And so that's where their projections were, and that came in line with kind of where maybe a little bit more aggressive, I would say, in terms of the projections. But again, the projections and the increase in the projections should not be surprising to anybody. And I don't think it was surprising to the 17 voting members of the Fed here, Tim. When you're looking at the dot plot here, and again, when you're looking at revisions and guidance of 6.5% for GDP and 2.2, 2.4% for your inflationary reports, those are really big numbers. And those numbers do suggest that the Fed should act, and they should raise interest rates based on those numbers. And I do believe that there are members of the Fed that do agree with that. You say, and that's what the dot plot is, guys. You saw revisions on the dot plot as well. And what did you see? You saw in 2021, there is not an expected interest rate hike according to the dot plot. In 2022, there is not an expected interest rate hike in 2022. But in their dot plot from December, there was one voting member that expected an interest rate hike in 2022. Now there are 4. In 2023, there were 4 members that expected an interest rate hike. Now there are 7. So Powell talked a lot about yesterday about how, yes, these are projections. Yes, these projections, if they do come true, we will be ready to act. But he was very cautious about that, saying these are just projections and we have not seen these come to fruition yet. And so he talked about how his guidance over throughout 2024 might not be as consistent with where they expect their projections from inflation and GDP in 2021. I think what we saw yesterday in the dot plot and what we saw in terms of their projection analysis is there are members of the Fed that agree with individuals such as Bill Gross. that the inflationary pressure running hotter is simply going to force the Fed to act sooner than what Jay Powell truly wants to do. Jay Powell was begging for everybody just to focus on 2024 yesterday. I can't tell you how much Jay Powell hates the dot plot, but I'm willing to bet he hates the dot plot more than I hate Deutsche Bank. And that says something, because I'm not sure I hate anything more than I hate Deutsche Bank. I'm not sure, but Jay Powell hates the dot plot that much. He wants people to focus on what's happening with interest rates in 2024, but the dot plot does suggest the Fed could act before then. And so I think that when you're looking at, those takeaways, right, those takeaways from the Fed, I think what the Fed did yesterday was they basically just threw a little bit of a gas on the current theme in the market.
Mm-hmm.
The economy is going to run a little hotter than anticipated, and thus inflation is going to run a little hotter than anticipated. So right now, it's a little bit of a mixed bag, a little bit. Personally, I feel this data, especially if these metrics are anywhere close to being accurate. Like if we're close to 6.5% GDP growth by the end of the year, and if we're close to, low to mid 2% inflationary goal, guys, you might not want the Fed to act in the stock market, but I promise you want the Fed to act in your life, because those numbers will be very concerning longer term. And so it's going to be interesting to see if Jay Powell can continue to walk that fine line on thin ice regarding the interest rate and inflationary conversation. He tried to punt yesterday. I think over time we're going to look at this, and it's a little bit of a mixed bag. But overall, the economy is going to run hot. Inflation is going to run hot. The Fed is going to be data driven. They're going to be data driven, which means they're not going to act until they see the inflation right in their faces and not based on their projections. And I think that's a little scary concept, quite frankly.
Mm-hmm. Well, and they were trying to press him on that a little bit, like Chair Powell, if this is the growth that you're projecting, how can you see that you won't raise interest rates? It was even so funny how almost ambivalent these reporters were, Matt. They won't push him too hard. They try to get their question in such a subtle, soft way, like, Chair Powell, I want to ask you this really in a soft way with a pillow, just lay down and can you maybe explain why you believe this or that? And then they just let him punt.
It's shockingly bad.
Yeah.
I mean, it's shockingly bad. The question I had before the presser was, how can you not see an interest rate hike in an environment where your GDP projections are the highest since the mid-1980s and your inflationary goals achieved, right? That's the question I wanted to see, because that's their mandate. Your mandate is stabilizing prices. You're now seeing prices that are not stable. Your mandate is to ensure that the labor market is maximized, and your projections say that the labor market's going to contract to 4.5%. So your GDP is expected to hit 6.5%. Your inflation is supposed to be hitting 2.4%. Your labor market numbers are supposed to contract to 4.5%. Okay, I get that these are projections according to you, but these projections are based on everything you're seeing right now. So if you achieve these projections, are you going to raise interest rates? And if not, why? Because you hit your projections, you hit your mandate. Why are you not acting? And there was a couple subtle questions like that yesterday, Tim. Like there was a question, I forget the individual who asked, but they asked, you are projecting a very low unemployment, great GDP, hot inflation, but no rate hikes. And so it was a very similar question to the one that I want asked. And Powell's answer was, quite frankly, disgustingly cookie cutter, just disgustingly cookie cutter. Powell states, what the SEP really states is we are committed to our guidance and that the economy 2 to 3 years from now is highly uncertain. Why do you have a job? Like, what are we doing? So you have your projections based on the data you're seeing right now, but you're telling us those projections aren't accurate and that you're going to wait to see if they're actually accurate? Like, what are we doing? I could get a kid off the street to give us that type of analysis. I thought it was, I get it, Powell's got a tough job, but he's paid to do a tough job. And his feet should be held to the fire for giving mixed messages yesterday.
Yeah, lots of mixed messaging, especially as you know in those Q&A sessions. I agree. Mark, you were there. What's your reaction to the market conditions here today, and also just the Fed in general while we're talking about Fed?
And just to build on what Matt said, which was, agree with completely. When I have a lot of exposure to value, a lot of exposure to inflation trades. And so I was looking at it through selfish eyes, trying to analyze it. And what I heard from Powell is the value trade is the place to be. Inflation plays are the place to be. And, I even said that. And Tim, you asked me a question yesterday. It's like, well, why do you think algos or why do you think tech still could have some rough spots? And I'm like, it's the real rates. We're not done with that. There's going to be times, there's going to be days where real rates go up and tech sells off big out of nowhere. And, I didn't expect it to happen the next day. But boy, 10-year yield, because basically Powell said, I'm not going to do Operation Twist. He didn't use those words, but he might as well have. I'm very happy and not concerned with where real rates are. The referring to whatever 10-year whatever those longer term rates and the bond sell off on the short term, basically said I'm not concerned about it at all. And so I thought there would be days. I really didn't expect the next day, but that's how fast the markets are. And of course real rates jump big time up to 1.75 on the 10-year today. And of course the algorithmic machines, they are programmed on big rate hikes, and they got a program. Eventually that program will do something else, and they'll get do something else. But it is rates down, tech down, gold down when real rates get a spike, and then banks go up. And you look at the bank performance today, you look at JP Morgan, and I'd like to thank Tyler for TradeMaster's bull call spread on JP Morgan from a couple of weeks ago that I wouldn't have done. You look at Wells Fargo, you look at all the banks. And so big jump today on real rates, tech sells off. Now, once again, this will ebb and flow. It doesn't mean tech's dead or anything like that, but it does mean that these days when you have real rate spikes, they're going to get you every once in a while. If and they're going to help you if you have banks.
Well, and like I said, I said this on Facebook, I said it here today. I think what Powell did is he threw in everything. He threw a little bit of gas on the current theme in the market. Not a little bit of water, a little bit of gas on the current theme in the market. Economy reopening up thing. Well, where does that play out? That plays out in the cyclical environment, right? That's your finance, that's your energy, that's your materials, that's your industrials. Those are your cyclical areas of the market. Where does that give a little bit of additional volatility? To the Nasdaq, to the tech place, right? That's been caught up in the high multiple, growth concern, right? That has a little bit more concern than say energy, industrial based material finance, the cyclical movement. And so, yeah, I do think Powell signaled the approval to a certain extent that we've been talking about for the last 3 months since December, since the last time they updated the dot plot, that the play here was the economy reopening up. The play here was the cyclical play. The play here was, was to a certain extent the what Greg is going to talk about a little bit, value, dividend, that type of area of the market. And, tackle trade rankings have reflected that. And, I've given it close to 24 hours of contemplation. I want to give it a little bit more time. But again, and the more time is more just to see market response over the next 24 hours more than anything. But to me, what Powell did signal was just a little bit of gas on that current theme in the market. And I think it separates itself even more.
Yeah, I think it's a great way to think about it. The gas on the current theme of the market. We're seeing it in the price action here today.
And I don't think Powell wants that, guys. I really don't. I look at it a little bit yesterday, and I see it through the ends of what's his intended purpose here. If the intended purpose is to get the economy back on track where it can run on its own, at some point you have to stop acting. And the Fed has been an extremely active, it's like an active judge, right? It's like an active judge. The Fed has been an extremely active judge over the course of the last year. At some point, if you want that to be if you want things to get back to some type of normalcy, at some point you got to stop manipulating the price. And so I do have criticisms for Chairman Powell, no doubt. But on another level, I kind of like the fact that he's not just capitulating to the market yet again.
Mhm.
And I kind of like the fact that he's not willing to employ a fairly aggressive monetary policy to fix something in the short term when he's trying to fix something in the long term. And so I kind of, I want to give it a little bit more time and contemplation to kind of truly understand what's going on here, because there were mixed signals yesterday.
And that may be what the
And
market's
just one-
doing right now. Go ahead, Mark.
One last thought on it. Like, say, we've been all over the value trade for, I mean, how long, Matt? Like a
4
while, a long time now.
What day was the election?
Yeah,
Almost
I mean,
4.5
so,
months.
It was the
and
day after the election. I literally said it here in the halftime report. I did a whole detailed thing on this being sector rotation.
you know, and you look at our picks, you look at our analysis of tackle trading for months now. It's been pushing the value because it's been easy. Like, seriously, if you argue against the value trade after yesterday's presser, I don't know what to say, because it is literally a green light. Strong economy, inflation pushing, those real rates go up. I just think it's value.
And we're gonna, and we is a broad-based term for market participants, but we're gonna look at that and we're gonna narrow down the topic. Is it value versus growth? Is it cyclical, non-cyclical? However you want to categorize it. I see this as personally, I see it as a cyclical non-cyclical movement, but value certainly has a higher percentage of that float in the cyclical side.
Yeah, I mean, well said.
Right.
Yes.
So yeah, however you want to categorize it, they all kind of get lumped into the same category.
Mm-hmm. Yeah. You know, as I'm looking at the markets, thinking through the conversation as we're having it here, listening to you, Matt, I do think the market obviously still feels there's mixed messaging here a little bit as well, because they initially popped up and now we're kind of giving some of those gains back. Greg, can you bring your screens up here?
Again, if you take their projections, right, and just think about it as an American consumer for a second, and we're hearing our economy is going to improve from 4.2% growth this year to 6.5% growth this year. Aren't we all a little happy about that, guys? Like more people have jobs, wages going up, people are paying their bills. Like, aren't we excited about that? Right? Well, inflation's going to run a little hotter in that environment. That's 2 + 2 type math, right? It's Econ 101. So I do think we need to give this a little bit of time, because there was some mixed messages. But as of right now, I do believe gas was thrown on the theme.
Yeah. Greg, give me a technical read on these indexes if you can. Just kind of walk me through what you're seeing, kind of adding to what Matt's conversation was there.
Yeah, so, with the Fed yesterday, I didn't dive into it as deep as you guys did. I was surprised by the initial pop, I guess, yesterday with the mixed messages that we were sent. But again, I think Matt made a good point about the algorithms, or Mark, maybe it was just Mark that made the comment, but the computers kind of kicked in and fired it up yesterday. And then, things kind of settled down overnight. And here we are today with, giving up a lot of the gains that were had yesterday. Really, we were in a holding pattern as far as I was concerned for the few days before the announcement. And it almost seems like we're back in that space now because of those mixed messages. The part that struck me as I guess not odd, but just different, was the fact that, we've been hearing for years preaching the 2% inflation rate. And then all of a sudden when things change or when they're projected to change, they kind of move the goalpost to 2.2% in the inflation rate. So it was interesting, and just the way you guys were talking about, I didn't see the presser yesterday, but the way you guys were talking about how he was speaking, that was kind of exactly what I expected, from the announcement itself. I expected just a lot of, we're just going to keep things rocking here, keep it moving along, nothing to see here. And I think that's really what it was. And I think the markets are trying to digest it and figure out, okay, where are we going next? And, the value, I guess I'm being vindicated a little bit there. I've always been the big value guy. I think that's pretty much how I got the nickname Old Money. But you know, I'm loving this rotation, the move into cyclical, you know what I mean? Just the value stocks are doing well, and I think it's a safer place to be at this point in time, especially if there's uncertainty, right? So, you know, there's less emphasis on the growth, which is still there, obviously in pockets, but you know, that we're playing catch up. We're playing catch up in energy, and we're playing catch up in some of the, you know, the more beaten down value stocks. So,
well, and two things: growth concerns are going to impact every aspect of the marketplace. Okay, cyclical, non-cyclical, value, dividend, growth, right? It's going to impact everything, but it simply impacts tech and discretionary more, right? And that's why the storyline is really kind of housed there. But I do want to make one point. I keep saying I think we should give this a little bit more time. And one of the reasons I say that is not simply because we need more time to digest what Jay Powell said yesterday and the market response specifically to Jay Powell yesterday. When you understand central banks, you got a couple things happening today. First and foremost, you had Powell yesterday, you had the Bank of London last night, and you have the Bank of Japan today, and you had Jay Powell have an emergency red economic report given a speech to the Bank of International Settlements on a day where 3 central banks around the world all simultaneously acted in a very similar capacity. So I personally would like a little bit more time to digest not just the central bank and the actions through the United States Central Bank, but more time to understand what is happening and if there's some coordinated efforts with London, Japan, and the Bank of International Settlements as well, because that'll certainly have an impact on U.S. monetary policy moving forward.
Yeah, and that's interesting you said that, Mac. I caught a headline this morning when I was going through my news feed that it was almost verbatim coming out of London, basically saying we're going to let inflation run higher. I mean, it is very coordinated, right?
And you're going to tell me that Carney and Corrado are just going to follow suit, just word for word, without them discussing at the Bank of International Settlements? Come on. No, that's like saying, hey, Matt's not going to talk to Mark about the Fed.
And Matt, I would, when you contemplate that, I'd be very curious. You know, you spend some time, because you spend more time on this than anyone at Tackle Trading, these type of subjects, what it means. If there is a mass coordination to run inflation higher, if there is this mass joint policy, what does it mean? You know, think about that. You know, I mean,
well, a lot of it's going to be thinking about debt, but yeah. I just think we need more time to digest price action here. That's it.
Yeah.
I think there's going to be a lot of hot takes today. I think there's going to be a lot of hot takes today. I certainly have some hot takes today. But again, I do think we all need more time to digest what the central banks are doing right now.
I think the market's telling us exactly that as well, right? We're looking at what, 3 dojis in a row pretty much, right? So it's telling us the exact same thing, you know, at least on these futures contracts for the S&P 500. So
my initial reaction as I saw the projections coming out is like they're signaling party on, right? I mean, that was my initial reaction. As I was watching the presser, you know, it was party on, but what are you trying to say here, pal? You know, and then it was like, that doesn't make sense. Like, that just doesn't make any sense. Like, that answer makes 0 sense to that question. And then was like, I give up, I'm done. And then it like, yeah, so I do think we all need more time to digest 3 major central bank announcements over a 24-hour time period. And I think it's okay to allow the bond market to a little bit of volatility as it tries to figure out what the hell these central banks are doing right now too.
Well, at 1.74%, I got to continue to reiterate some basic common sense here. We're still near ranges we've been in over the last several years. Number one, 30-year mortgage rates are still near ranges they've been in for the last several years.
That's not the story for me, though. That's not the story for me, and that has not been the story for me in the last month either. The story for me will always be does these projections force the Fed to actually raise rates? Because that's a real story and not just some manufactured stuff we need to talk about on a daily basis.
Greg, give me the Nasdaq. I think we got to at least speak at that chart, because the S&P, you're right, doji a little bit. We're in a tight range up here at the top. Obviously, a different technical read here, guys. And in the short term, we got to acknowledge what's going on with that red candle. What are you guys seeing in the chart? Let's start with you, Matt, because this is one we've been analyzing quite a bit for a while.
Yeah, I think you got a very similar read today that as you've had over the last week. You know, you've been looking at K-trade analysis on this, and I still think you're looking at K-trade analysis on this. And for those of you that are new, K-trade is that you're looking at an intraday or a daily time frame where you could see a breakout one way or the other. And so you really don't want to, you know, be aggressive in where you want to move, right? You want to kind of see that confirm one way or the other. The K-trade is actually a day trade that we love doing in the currency market on an economic event, but it's the same concept. You don't have a bias one way or the other. You're saying if it breaks up, I'm a buyer. If it breaks down, I'm a seller. That's the K-trade. And so I do think you're in K-trade analysis right now, and not your standard bearish retracement analysis. And so for me, everything starts on the intraday here. So if you'll drive that, you know, put that on an hourly chart or a 30-minute time frame, either one's perfectly fine. You'll see that wide range volatility, and you're really kissing against some fairly important short-term support levels. And so right now you got a double top, double bottom scenario. Again, K-trade type of analysis. You break out, you're confirming to the top side, and you're confirming the buying decision, right? It confirms to the downside. You're like, let me just stay away from the Nasdaq because good luck shorting.
Yeah. Greg, obviously some pressure there, like Matt's talking about here. We're sitting on support. This has been a weaker area of the market. Where there is some strength in the market's obviously been around the Dow Jones. We'll look at that one here in just a second. But Greg, anything you want to add to the NQ here that you're seeing?
Yeah, the only thing that I agree with Matt 100%. It's you really got to wait for these important levels to be broken before you can decide which way to go. But what I find very interesting is this 50 MA that I've got on here. You know, it's just struggling to get above and stay above that, right? Mm-hmm. So it feels, you know, obviously seeing the numbers and just looking at the candles as they are, it feels a little bit weaker than everything else, and rightfully so, right? So again, you know, there's not really a trade you can take, I don't think, because you're kind of right in the middle of this bigger consolidation. You know, I've got a couple of lines drawn here. You know, it was some really wide consolidation here, and you're right smack dab back in the middle of that. So trying to play that one way or another, the risk reward setup just isn't great. So like I said, for me, I'm looking for the break above, just like Matt is, or the break below. You know, if you're going break below, you got to be careful. You do have some more support down at this level here. So really not much else to add. It's, you know, as far as I'm concerned, and I've felt this for the last few days, this is kind of a wait and see, you know, where things want to go. And you add into the Fed speak that we've talked about, you know, it's really a challenging, as far as I'm concerned, it's a challenging time to be taking, you know, specific trades at this point in time. You want to make sure that you've always got a good setup, and right now it's tough to see those setups as far as I'm concerned.
Mm-hmm. Mark, anything on tech? This is obviously the big mover here today, catching the attention. Anything you want to add?
No, I mean, no, this is technical analysis right now. Absolutely. Like, you know, because you can guess all you want about this and that. It's technical.
There's only Mark's right, Greg's right. There's only one thing you care about on that Nasdaq chart, and that is the intraday chart right now.
Intraday technical analysis.
Yeah. You know the theme. Again, you know the theme.
Yeah.
The Fed threw gas on that theme. You know the theme. There is growth concern in the Nasdaq as tied to inflation if the Fed's going to be forced to act in an economy getting back to pre-COVID levels. We know the theme. Nasdaq's still in the, and again, post-Fed, we don't need time for this. Nasdaq's still in volatile nightmare right now.
No, and a lot of people have tech long-term holdings, right? I mean, there's so many beautiful names in the tech space. You know, and if you don't know how to cash flow, even if it's with like way out of the money covered calls, and you don't, I mean, it's not a terrible time to do that, especially if you see a support level break. If you see a support level break, not a lot of support they're holding up to the next level down.
How are you guys handling your long-term tech holdings here? And specifically, from a hedging perspective, because there's lots of ways to hedge, right? Even reducing exposure is a hedge, right? You're reducing exposure. So let's go from it specifically tech and discretionary, which is tied to this current negative theme, specifically to these two sectors. Are you going to reduce exposure? 1. 2, write covered calls to offset short-term risk. 2, or 3, buy put options because you're scared for the end of the world happening, and whatever other weird analogy I could figure out right now.
I'll go first on that. Yeah,
because that will tell me your the level of your concern.
I'll go first on that. I'm not adding any exposure. I'm not reducing
That
any
wasn't one of the
exposure,
options.
and
I
I'm
didn't
not
say
buying
add.
put options. I'm not
He's
buying
trying
put
to do
options.
my
Play the
game,
game.
Tim, where he
Play
can
the
win all
game.
things.
Play the game. One of 3.
I'm not reducing exposure. I'm not adding put options, and I'm not doing anything with my long-term tech holdings.
So
They're
you're not
sitting
writing
there.
cover calls either?
Well, a lot of them are at lows. Like I'll give you an example, like CRM. I will write cover calls on them, but I haven't in the last 2 days.
So,
or this
okay.
week.
Well, again, I don't care what you did 2 days ago. I just, in general, right now, how are you treating it?
Yeah, I always am willing to write cover calls on my shares.
Y'all need to stop acting like the Fed. I've got enough bullshit dancing over the last 24 hours, and give me a direct response, please.
I don't currently have cover calls on my tech holdings. I have zero cover calls on my tech holdings.
That also tells me you're not concerned about the tech movement then.
Come on, Tim. Matt just gave us a kill one, marry one, bleep one,
Yeah,
and you just sat on the fence, right?
He's like, I'm gonna kill and marry and murder all
he'd
the
play the
same
game, and Tim said,
individual.
"I'm gonna read a book."
Okay,
Where we book?
Not reducing, no put options,
again,
no cover calls. Answer all 3 directly.
And very clearly, the Nasdaq's in a bearish, bearish little short-term bearish downtrend, could trigger down. And you're saying, I don't care if CRM goes to 200, I'm not going to cover.
I'm not currently covered.
Okay.
Well, what if support breaks? Are you going to sell covered calls?
What if?
Yeah, what if that Nasdaq support level breaks? You going to sell covered calls?
If that Nasdaq support level breaks, you better buy put options. Like we'll talk that later. We're talking right now. So Tim, you're a nothing burger in the Nasdaq right now. You're like, I don't care about anything that's happening right now.
Correct.
Such a nihilist.
Sometimes I wish I had his mindset, but he really is a nihilist. Greg, what about you?
Well, this isn't the prettiest pivot I've ever seen on this index, but didn't want to do that. But with this pivot here, that's typically how I do things. So I have this covered. Any tech plays that I have, I don't have a lot, obviously, but I do have them covered. As soon as I see a pivot up, I cover it with an out of the money covered call. Now, if support breaks, that turns in typically to an in the money covered call. I will roll down to the next level. That's kind of how I play it. So down at the bottom, when we pivoted down here, that's when I get rid of the covered calls and I try to do the same. And I'll be the first to tell you, I'm not perfect at it. It's hit or miss.
It's a good approach though when you're in a bearish trade.
At this point in time, as far as I'm concerned, this pivot is lower than what this level was before. Like I said, not the prettiest one just because of where the wicks are. But as far as I'm concerned, that's a lower low, or sorry, a lower high, I should say. And we've got a lower low. So for me, I can cover it there because it doesn't really bother me. If it spins the other way, I'll pull it off, I'll roll it up, whatever I got to do. Yeah. That doesn't bother me. I'm more of a type of person who keeps things covered more.
Okay. Often, so if I'm picturing this on a risk graph, right? Yes. Tim's got that vertical risk graph, right? He's just like, I'm taking the risk to the downside. I don't care. I think this is an overreaction. And I don't want to put words in Tim's mouth, but is that accurate, Tim?
Yeah, I think short term. Yeah, overreaction.
Okay. And Greg, you're saying, you know what? I see a little bit of a technical lower low, the lower high here. I'm a little bit concerned about this growth story. I'm going to write covered calls just to offset some of the short-term risk, correct?
So Tim was the upward.
Tim is the unleash the Kraken and let it roll.
And this is my risk graph right
here. And you have the flatlined. You shut down that growth side of it real fast, right? Yeah. So you shut down that growth side. Mark, what about you? Are you just right now specific? Because I know, like Greg, you got a lot in value, you got a lot in dividend, you got a lot in cyclical, right? You like that. You like those types of companies that actually build stuff.
Yeah.
right? Right. Mark, you like those types of companies that don't build anything, which means you got some risk here.
I got
bro.
Lucid Motors, CCIV, right?
They not
haven't
only
made a car yet.
they not only not build things, they haven't sold anything either. So Mark, you're the opposite of Greg here. You got a lot of exposure to the downside risk here with the Nasdaq and the growth area.
Yeah, not
Are
as much as I
you-
did 3 weeks ago. Yeah, because a lot of the stuff, well, I don't have your traditional plays like Apple and Microsoft and that. I don't have anything in that area.
You have Lucid Motors.
I do have
and
stocks.
Chico Foss.
Well, Chico Foss isn't tied in the tech. Hey, Chico's
I just
up. Go
wanted
look
to
at
say it.
Chico
I just
Foss.
wanted to say it. We don't need to look at it. I just wanted to say it. There's
Chico
a difference.
Foss up 11% today. So
Look at you,
symbol?
buddy. It doesn't matter.
CHS. But anyways, I got a lot of stuff like Lucid and other things that are tied to NASDAQ moment. The NASDAQ sells off. These are going to follow with it. I don't know how you don't have at a minimum, like let's say you're like, oh my gosh, I'm all growth. Like, man, you can pick up some premium way up there on high delta chains that are easy to manage. I don't know how you don't do that.
Okay, so just to bring it back. So again, to answer the question, Tim, you're open-ended risk graph, taking the risk.
Mhm.
Greg, you're going to reduce exposure, bring down that risk graph so that you're a little bit more controlling the growth side of it. And Mark, you're in the let's reduce exposure, lock in some of that short-term risk, move it out of the table while you cover the other side of it.
Yeah,
So-
no, I mean, and I think you should have started, and we've talked about this, reducing risk the last few weeks.
Yeah.
Okay. That doesn't mean you have no risk, right? I mean, I'm all bull. I think this market's going to do well
so the
this
question
year.
who's right and who's wrong here?
Nope. Well, who will play out in the short term? But
No.
I don't think anyone's
The question
wrong.
wasn't about
Here's-
the short term.
it's-
The question was
no,
about
no,
the
no.
long term.
No. See, now Mark and Tim's like, I'm right, you're wrong. That's not my point. My point is you're all right because y'all did exactly what fits who you guys are as traders. Tim, you are that individual. You're the guy saying that, no, I like CRM at the lows. Why am I going to cover it? I want to add more, right? I'm holding CRM for 10 years. Why? I'm not going to nickel and dime this. Greg, you're like, I'm a little concerned. I'm going to write those covered calls. Mark, I'm going to freak out and reduce exposure and write covered calls. It fits who you are. But the beautiful thing is all of you made a decision. Now you're doing it. The only problem I have in these environments is people who just duck their head in the sand.
Yeah, I agree with that. Yeah, you have to build a trading plan and a portfolio design around your personality, your long-term objectives, whatever those are, and you have to execute them.
I
You
mean,
can't
whoever you
ignore
are,
market conditions.
if yesterday in that Fed press conference didn't let you need to grow your money is going to be worth less. Your actual dollars, those dollars underneath the mattress that our grandma used to put, they're worth less at the end of the year. If you're not growing it, I don't know what.
If there's one thing that I think all of us can agree with what Jay Powell said yesterday, he said buy stocks.
Yes, he did. Yes, he did.
That's what he said. He said buy stocks. I truly do feel bad for anybody that does not own stocks over the next 10 years with what is coming down at us from an inflationary perspective. Because they're talking 2.4 next year, guys. I think that's a bold-faced lie. I think that's already here.
Yeah.
I think we're already dealing with that. So when they talk 2.4%, you're talking double whatever you're paying right now.
Yeah, tell me that food prices already aren't up over that gas prices already aren't over that housing prices already. I mean, so many things that we use on a daily basis have already surpassed those numbers. So those numbers, whatever comical joke they use to lie and manipulate them outright, the BLS that puts out the survey, the inflationary survey, basically said we're making up figures this month.
Short term, the market's going to do whatever it's going to do. The Nasdaq's going to play out that story.
You have to grow your money
to own stocks over the long term, 100%.
I agree with that. Look, guys, let's flash through the commodity markets here. Conversation, I'm loving it here today, but we got to keep moving through the markets if we can. Crude oil is taking it on the chin here today. Mark down on what are we now? 5.5%. That technical trend is officially over. If it was even under a debate there at some point there. Matt, you've been talking about crude oil losing momentum, changing its characteristics. You've been on top of this here for a while. What are you seeing in the chart here alone? And then Mark, if there's anything in the news, let us know.
Well, what do you want me to say on this one? I've said the directional movement was over for a month. Like, I don't know what you want me to say on it though.
Just how do you read it now with this sell-off?
I think as long as crude stays above $50, energy is going to be fine.
Yeah, I agree with that. Mark, is there any news driving this here today?
It's been a constant whittle. The causal things are Europe. Europe has had a mess of their vaccine rollout. I mean, kudos to the United States, other areas, other countries. Europe, they just they haven't done a very good job. A lot of that had to do with AstraZeneca. They're talking about some lockdowns in Paris now, and so Europe needs to get it. Now they'll get it right? You know, the vaccine's there, they'll get it right. It's a short-term hiccup. But, you know, really when you look at it, you know, whatever the excuse of the headline is, the theme's all there still on oil. It just had ran really, really fast, really, really far. I mean, that's just normal. We talked about this the other day. You know, when you get too far overextended, pullback consolidation's the norm. You know, that's going to be the case. And then the storyline will play out. But the major themes on oil are all still there.
You know, a great deal of this selling to the downside here intraday has just happened after the cash open. So really technically driven in that regard. From there, let's keep moving through gold, then the dollar, then Bitcoin, and then we're going to get into some stocks. And Greg's got some ideas later in the show around value and dividends that I do want to hear. I'm excited to hear what old money has to bring. Gold, I'd got not much on that chart to update here, guys. Mark, anything you've seen in gold?
By the way, I have oil as a technical break of intraday support that ran out of control.
Yeah, that's what I'm seeing on the intraday as well. Yeah,
happened at the cash open on an economic report.
I was gonna say I did read that we got a surplus in the U.S. for oil as well. There was an uptick in that, and I think that's probably got a little bit to the momentum part of the breakdown.
It was a little bit weird too, Greg, because we've had that same uptick the last couple of weeks and crude hadn't responded, and it's kind of like, what's going on? And so I think you maybe got a little bit of confirmation here with what's been going on the last couple weeks. But then you look at that from an intraday perspective on the cash open with that report, violated support, and now it's in an intraday pretty consistent downtrend.
Well, and I saw the supply number as well, Greg, but it didn't really move on that. It moved today on the cash open, like on that Matt's talking about. I even saw an IEA report that world gasoline demand is never going to come back to pre-pandemic levels, but it didn't move on that report either.
Hold on. I hate when people state the obvious. Just
people are going to work from home, and some consumer behavior is going to shift, and we're now going to use electric
I need
vehicles.
to learn to have more conversations stating the obvious. Lots of people have a lot of happy conversations just stating the obvious.
Yeah, sun's out today.
Yeah. Oh yeah, sun is out.
Look at that. It's a nice sunny
day. Isn't it shiny out there, Tim?
Yeah, it sure is.
I wonder if it's warm.
It's nicer. It's a little bit warmer than it was yesterday. Yeah.
The 400th million day in a row. Imagine that. So
I'll smack myself in the face.
All right. Back on gold real quick. Anybody got anything they want to add to gold? Charts where it is. It's not been doing much. It's got to
and once again, this dang algo program that's running on some of these areas, I keep waiting for it to break on gold, because you saw gold run after the Fed meeting. You saw gold run on the Fed meeting, real rates thing, but you're not seeing as big a sell-off on this. I mean, because that was a big jump in rates, and gold didn't sell off as much. And look at the rebound intraday. I just got this feeling that gold is starting some bottoming process, and there might be opportunity coming up. I'm more interested in it than I have been in a bit.
I think it's a ways off for me, though, in terms of technicals. Long-term investing, we don't need to have that conversation. We've had it.
Well, that's all I'm referring to, like as far as, you know, adding to a position or whatever.
Yeah. Dollar's not doing anything.
Initial response was, inflation's going to run hot. You want to buy gold. Secondary response, after I had a second to think about it, was, but if this forces the Fed to raise rates sooner than later, that's not good for gold. It needs time.
Needs a little bit of time here. What are you seeing in the dollar, Greg? I'm seeing you drawing lines now. You got my interest.
Somebody draws lines, I'm done. It's like, it's up. Bye.
No, it's just it's what I look for, right? I'm looking for higher lows and higher highs, and it's starting to put that in on this chart there, right? So, you know, we've had a pretty solid beat down. Kind of looks like it's found a little bottom there, and it's starting to work its way higher. Now, where's it going from here? I'm not willing to hazard a guess at this point in time because there's a fair bit of overhead resistance. But like I said, when you start to see these higher highs and higher lows, well, that's the definition of an uptrend. So, albeit a very, very minor one, it's starting to do that. So that could go back to your crude oil as well, right? Higher dollar makes it more expensive. So, you know, it's all tied together.
Greg, you said you don't know where it wants to go. We're talking about the dollar. Zero is where it wants to go. Zero.
Yeah. I 100% agree. I kind of meant within like the next week or two.
Okay,
not within the next 60 years.
If we were talking about the ruble, maybe, but not the dollar. No.
By the way, while we're on the dollar, it always reminds me to talk economic data. The Philly Fed Manufacturing Index did come out this morning. If you try, listen, this is one.
I don't even know what to say about that. I don't. An expected Philly Fed coming in at 23, comes in at 51, and prices at 70. Okay.
That thing exploded. Like, I don't put a lot of things in, but I still look and I was like, wow.
It exploded based on prices paid. Oh my goodness.
Yeah. Listen, grow your money. Inflation's here. Find a few good inflation trades.
Mm-hmm. I agree with that. The inflation rate from the Philly Fed was the highest it had been measured since 1980 as well. And that, like you said, surging prices are what manufacturing purchasers cited.
Y'all don't want to talk about the economic conditions that had that happen in 1980.
Yeah, you know what? Interest rates were at 14%.
Yeah, you buying a house at 18% interest rates?
Man, listen, I have a feeling at some point.
Oh yeah, but Mark, you old boomers though, you don't even know about the new age economics.
Listen, at some point in the future,
I swear my daughter's running the Fed.
We are going to be ranting about the Fed and their hubris and how they thought that they could get everything magically right, and how something just imploded in that great plan.
No, it's different this time,
it's real simple. Their greed imploded. That's pretty simple.
Yeah.
But listen, I'll worry about that tomorrow. I got to make money this month. So
Bitcoin's going to be making some money, threatening to break out 60K here. You got a lot of response on Bitcoin here.
Obviously a very positive response. It's been holding up against market pressure for some time here, guys. And obviously, you know, here we are pushing into a new high. There was one corporate note, Morgan Stanley, as the latest of the Wall Street firms to add Bitcoin to their clients' accessibility. They're going to allow their wealthier clients to purchase Bitcoin through a couple of different funds. But that's just another corporate adoptability. Wall Street jumping on the bandwagon story. Bitcoin is just resilient. It really is incredibly resilient. If you think about it, it ran on the Fed yesterday. It's running here this morning while the Nasdaq's selling off. You got to love it if you're a Bitcoin holder. You got to love it if you're bullish on crypto. Marky, what's your read here?
No, it was a nice little 1-2 sentiment bump, right? Because, you know, there's been two major themes that when you go to Bitcoin and say, what are the sentiment themes? What are the themes driving this? One's inflation. One is corporate adoption. Now, corporate adoption is the big one for me, but the little inflation one in the background, you know, Bitcoin, a lot of Bitcoin bulls love. Listen, you got a 1-2 beautiful punch on both themes yesterday. Morgan Stanley continuing the ongoing adoption, inflation from the Fed. It was a nice 1-2 punch. So I wouldn't be surprised.
I'm so concerned about inflation. I'm about to make an argument that Bitcoin's inflationary protection.
Listen, Bitcoin bulls would be like, yeah.
And they'd be like, so Matt, you finally joined us.
Yeah, right. That's that's exactly why I'm smiling right now. You jumping on there, bro?
No, absolutely not. Absolutely
listen, there's room on the back. Well, listen, I wasn't afraid to join the bandwagon.
Y'all are wrong. Bitcoin's not an inflationary protection mechanism, but what the hell else are we going to do? Let's just have some fun.
It is not an inflationary. I agree with you.
If we're just going to start making up stuff, then yeah, let's do it. Bitcoin's inflationary protection. Just go with it.
But it is a theme out there that Bitcoin boils love, even though I agree with you in the grand picture.
No, I'm capitulating. What are you talking about?
Oh,
I'm saying,
hey, Greg,
the entire world is so stupid at this point that we might as well just embrace it.
Hey, Greg, you ready to
Yes.
join some Bitcoin? I got some Bitcoin miner picks. There's some real
Yeah.
deep value picks for you.
I'm good, buddy. I'll stick with my my food and my energy and
All
all
I'm
that
saying
stuff.
is this.
I like to hold stuff in my hands, and
Hey,
I'm pretty
Greg-
sure I can't hold Bitcoin. So
Greg's got eggs, milk, a loaf of bread, and guns, and he calls that inflationary protection. I love it.
that's right.
All I'm saying is this. When I'm looking at gold right now, and I'm saying, you know what? Gold's a buy based on everything the Fed said yesterday, right? Mark, would you
I
agree
think
with
so.
that? Okay.
Yeah.
But yet in my head, I'm thinking, yeah, but everything the Fed said yesterday is going to force the Fed to capitulate and raise interest rates faster, which is not going to be good for gold. So gold should go up, but we got to deal with all this massive nonsensical manipulation that we've had to deal with for the last 46 years in the gold markets. And so maybe, just hypothetically, maybe Bitcoin doesn't have to deal with any of that nonsense.
Yeah, I guess I fall under the Peter Schiff camp,
Yeah.
Like Peter Schiff, basically, huge gold bug, right? I disagree with him on Bitcoin completely. So do his.
I think his Bitcoin is a shtick, by the way.
But his basic take is, the Fed is never going to raise rates substantially. They can't. Too much debt in society. The ramifications would be too big, and so inflation is going to run away. I generally side with the Peter Schiff argument.
Oh.
So
I don't have much to say about Peter Schiff because I think what he's doing with Bitcoin is completely a shtick.
He's
but
lost it lately.
He's also lying about it, and you can see through it. Him and his son doing the whole "I love it, hate it." I don't like any aspect of it. But regarding Bitcoin, I don't know. I think we need to be open-minded to that conversation in what it could become. I don't think we're there yet, but man, again, it's performing like it.
Yeah, incredibly strong.
Gold volatile coming down on the overnight based on what the bond market is doing. Bitcoin up. I don't know.
Just
Impressive,
Maybe
to say the
plus
least.
two.
Yeah.
Maybe it's just easy.
Yeah.
I don't know.
I agree. All right, let's move into stock talk here because I actually want to hear Greg's picks here in just a few minutes as well. There's not that many corporate items I want to go through, but a couple of them here. We had a story like this just a couple of weeks ago. I think you're going to continue to hear this regurgitated story several times the next 6 months. Lyft, the ride-sharing company, said that last week was the best week it's had in over a year for volume, ride bookings, all of those type of things. Reopening theme kind of in play. Very, very strong chart here. We're seeing a little upward momentum. Is there a trade here, guys? Greg, what do you see in that chart right there?
It looks like a high base to me. It doesn't, just giving it a really quick once over here. I don't think it looks all that extended. I think you play the breakout of 68. That's the way I would play it. I don't think I think that's probably an all-time high if I'm guessing. No, maybe not. No. So, look at that.
All-time high? No, not on Lyft.
Jimmy Shield was pitching it.
My bad.
That got Jimmy Shield. Yeah.
It sure did. When Lyft IPO, Jim Cramer was, if you don't know, our affectionate name for Jim Cramer is Jimmy Shill. He was pumping Lyft, and I remember the halftime report specifically.
He was trying to retire.
And Matt's like, nope.
So July 15th of 2019 was the last time it was.
Go check the halftime report about what I was saying that IPO day.
That's exactly right. Do not touch this.
Call
what are you talking?
Kramer out live program.
That's exactly right.
It's ridiculous.
It's a pretty productive and effective looking chart here, Matt. If you're just reading technicals alone, I mean, that 68 break actually does take out that old resistance too.
Yeah,
you got a lot of room to run.
I think you're looking at 68 and you're saying anything aggressive above 68. You look at it from a weekly chart. Yeah, you're range up on the weekly chart, but you're kissing against that 68 handle from back in July last year. You look at the daily chart, you're forming a high base with a pretty clean trigger. Break it down on your narrowest time frame, put it on a 15-minute chart, 5-minute chart, 30-minute chart. You're going to see a pretty clean trigger at 68 that's currently happening literally right now. Mm-hmm. I think somebody at Tackle just put in that breakout.
Somebody
at Tackle saw that before we even got to talk, and they're like, "Yeah, we're going to front run you guys."
We're going to do this right now. Well, somebody's in. Obviously, intraday confirmations happening as we speak. Taking a look at that. A couple of quick earnings. WSM here, not much detail to it. Just want to kind of give the news. They're gapping out here today after they beat top end, bottom line. I know that, Matt, you had to buy a little bit of paint last year. Obviously, a lot of people doing home refurbishing projects and all that kind of stuff. Williams Sonoma got some kick there. Dollar General, real quick one here. They posted quarterly earnings and they got beat here, obviously dropping. This has been a stock under pressure for some time now. It's gapping down into support. Either of those companies you guys track or trade? Williams Sonoma, Dollar General. I don't really trade it too much.
I've traded Dollar General a few times, but not recently.
Yeah. AMC, the movie theater chain, also becoming a meme stock here recently, did announce that 99% of its locations
isn't it one of isn't it the mother to the
it's like the queen to the king.
GameStop and AMC,
it is the queen to the king.
Yeah, like GameStop is the meme stock, right?
Yes.
Well, to use the chess analogy, then GameStop's the queen, AMC's the king. Yes.
Yeah, that's how I was going with it. GameStop's the queen, AMC's the king.
Yeah. And it's been a juggernaut here the last little bit as those two types of plays have been picking up. They did announce that 99% of the theaters will be open by March 26th in the United States. A couple other quick ones here. Nikola. We don't talk about this stock hardly at all. It's been completely under pressure. It's never made any money. It's not caught up to its euphoric run from last year after all the nasty headlines it went through. Another one here, one of the biggest stakeholders they have in the company is selling half of their stake in the electric truck maker, kind of capitulating. We're seeing this over time.
Sold it all.
Yeah, that's what my first question was. Why are you going to sell half? Why not just dump it?
Probably because you can.
Yeah, possibly.
Yeah, I miss trading Nikola, but I found a new car maker that hasn't made any cars yet. So that's old news. They Nikola hasn't made any cars yet. But now I got a new one in Lucid that hasn't made any cars yet. So
I have a couple other things too.
If you guys remember not too long ago when this thing was going silly here, wasn't I the one that said something about somebody going to jail? I'm pretty sure they got their man if this thing's falling like it is.
You and many of us, it's obviously been a beaten up company for very good reason, quite frankly. And then the last one here for me, Carnival Cruise Lines, another example of analyst upgrade that you're going to see a lot as this reopening theme comes around. Sexy. They got an upgrade to a buy, upgraded at UBS, obviously citing, for future economic activity, increased bookings, anticipation of the economy reopening, all that kind of stuff. Little potential breakout up there, as well.
Yeah, the cup and handle ascending triangle action coming into a potential breakout of $30. That's forming up pretty decent above 30.
Sure is. Yeah.
I don't like it as much. I like lift above 68.
That lift trades up.
But I do like it above 30 here. That's pretty decent.
That's the news that grabbed my attention here today, and I want to move right into Greg's next segment, which is something I have no idea what stocks you brought here, Greg. I'm eagerly anticipating this all day. We do so many different things on the halftime report with our coaches. Last night we had a Trade Master show. They're talking swing trading, they're talking setups, option trades, that kind of stuff. I know you do all those things as well, but you are within our community. You are given the label Old Money Homes for a reason. You focus on dividends a lot. You focus on value. You have that perspective from a longer term perspective. I don't know what we're calling this segment, maybe old money wisdom, something like that with Coach Greg. But Greg, what you got here today for us?
Well, they should call me old and boring money homes, I guess, because that's what I look for. So my favorite recently is Verizon. I see these kinds of stocks. I take a look at where they're sitting, and then I do a deep dive into the fundamentals, and I do a deep dive into the dividend plays, and really, this is when you start to move away from the swing trades that we show on the stock reports and the option reports and things like that, and even the trade masters. And this start where you start looking at those building those positions, building those cash flow portfolios over time, which is where I kind of cut my teeth before I started trading all that other stuff. And it's things like Verizon here that just make me smile a little bit. Looking at this thing, it's essentially where it was, and obviously, some movement, but it's essentially where it was almost 3 years ago, slightly higher. But, we've had a good pullback into a solid support level here. It's now starting to take off both on the weekly and the daily chart. and we're starting to make these higher lows that I like. We're not quite into the higher highs yet, but we're starting to make that spin. And then when you start looking at this thing from a fundamental or a dividend standpoint, dividends is where I live, right? So just looking at this thing, it's a 4.5% dividend for this company's pretty solid. A couple other things that jump out at me here: 16 years of consecutive dividend increases. So got through some pretty tough economic times there. We're still pumping out the dividends, paying you a little bit more. Paid since '84. This is the part that I really like here, is this 58% dividend payout ratio. Essentially, for those who don't know, that's the amount of money they take from their earnings to pay the dividend. Well, at 58%, they could keep this up for a very long time. I don't think there's any danger. Looking at their little bar graph here, I don't see any danger of them cutting their dividend anytime soon. Not when only 58% of their earnings going to that. That leaves a fair bit of money and to reinvest in the company and do the other things they got to do. So, this is where I start. After this, I think you gotta look a little bit deeper. You can't just sit there and expect that the dividends are all fine. You got to look at the company itself and ask yourself some questions. I only have a couple of questions that, before I do the deep dive, just a real quick look at these things. I just want to know a couple of things. Number one, do I know their product? Absolutely. They're in the cell phone business. They're, what's that, 5G kind of stuff. They've got some things going on. They've got a pretty big market share. What I'm looking for here is, are they making money? That's the cold hard reality of it, right? So net income, they're definitely making money. Their income for this, which is something I don't really fancy that much, but I'm not too worried about it, is their net income's a bit up and down, right? 30, 15, 19, 17, but overall they're making cash, which is a good thing. Then I kind of go to one other thing that really, this is what I look at when I look at someone, an individual, a company, any business whatsoever. If you have more assets than you have liabilities, then you're probably doing okay. And for these guys here, their total assets are 316 billion and their total liabilities are 247 billion. So you close the company today and you're still looking at, geez, I don't even know what the math is there, but a lot of billions sitting around. So again, this is just kind of showing you a little bit of health of the company itself. And then finally, all I want to know is, do they have enough money to weather any financial storms going forward? And that's where I come to this free cash flow number here. And as you can see, the free cash flow number for these guys has kept increasing for the last 4 years. They're sitting on $21 billion there. So even if things get tough, more competition comes along, innovation, all that kind of stuff, I think they can weather the storm. So you look at these things and then you look at where the chart is. And again, Buffett said it best, right? You're looking for quality companies at fair prices, right? So yeah, sure, you could have bought this a little bit lower, other times. But as far as I'm concerned, at this point in time, this is a pretty fair price for this particular stock, and it's moving in the right direction as we start. So like I said, it just, the setup to me is good. It looks like it's trying to get above that 50 MA. Once it does, I think there's some growth, not really growth, but there's some upside potential to this as well. But again, then you start doing my favorite thing. You can cover call this and the return's not bad at all. So all of those things together kind of make me look at this and go, yeah, I could hold this for a while, right? And really build a position around it. So that's one of the first ones that I had today.
Let's talk about this one for a minute. Let's talk about this one, because I love the analysis, Greg. I appreciate you running through that, especially the dividend analysis. Always great to hear your thinking behind how you assess some of that stuff. And I know that was kind of a crash course real quick on that, but it's great to hear you think through that. You guys remember we had a little podcast game a few weeks ago, Marky, is that right? You remember this?
I do remember this.
What stock did I pick?
I think you took Verizon in the second round.
I sure did. So I like Greg's analysis here. I'm obviously speaking.
I know Matt's away right now because there's zero chance he could not comment on that. Listen, I've seen Greg do his dividend exercise many times now, and I love it each and every time. Because one, until before I became millennial, Mark, I spent a lot of time here, and I'll spend a lot of time here again one day when my current fix is over. And I love how Greg analyzes where to pick them up, because it's just not buy them, right? Hey, dividend company, buy them. But I love timing dividend companies on the entry, picking them up near support levels, finding my timing. I've seen Greg do this several times, using his knowledge of dividends and quality of the company and fundamentals, and then using technical buy off the bottom once momentum might start picking up. I've seen him do it several times. I love the approach. Just nothing but wonderful things to say, Greg.
I think that, sorry, Tim, I think one of the things too is when you can get a 4.5% dividend out of a company that's got as much history as this thing does, that's solid. Like, you can look at an ExxonMobil. ExxonMobil had a pretty, I think their dividends are around 5% now. I haven't looked at it recently. But they also had a payout ratio of a few 100%. You take a company like this where you're getting that 4.5% dividend, and you've got the security that they could have their earnings drop off pretty aggressively and still not break that 100% threshold on the payout ratio. That just gives you kind of a warm, at least for me, gives a warm fuzzy feeling that these guys know what they're doing, and that they've got the shareholders' best interests at heart. Because they could have a much bigger dividend, they could attract more attention, but they've chosen to kind of still keep it in a good range, but keep it steady as well from an earnings standpoint. So it's one of the things I really like about it.
Matt, any thoughts on Verizon here?
I love Greg's analysis, and in the 48th round of our draft, Tim, I'm going to pick AT&T to compete with your second round pick.
I knew it was coming.
I might have reached. Give me a long-term chart on this though, Greg. Obviously, we know the Buffett news from recently, the last couple of months. Buffett added a bunch of Verizon as in a traditional value play. Greg, it's not surprising to me you brought a dividend payer with just a long-term kind of boring chart to it when it's sitting down near the bottoms. It's not a growth play. Let's not call it anything that it's not. But from this type of analysis, if you're looking for this kind of exposure in the market, which I think people need some boring in their accounts, with some of the capital, nothing wrong with that. Dividend payer near support. I got no problem with this, Greg.
Listen, for me, it's really simple. If it's good enough for old money, and if it's good enough for the original old money, Warren Buffett, it's good enough for me.
Yeah, I love it.
So I would say you're right on the growth thing, but like one of the things that I like about this too, and again, it's not going to happen overnight. As you can see, it took from 62 to 54. It took a couple of 3 months maybe to get down there.
Isn't that a beautiful thing though, Greg? Let's stay on that just for a second, okay? Over a 3-month stretch in a tremendous bearish downtrend for Verizon goes from 62 to 54. In that same 3-month stretch that you lost $8 on your stock, what's the current? Hold on. Let me see this. Verizon. So we lost $8 on the stock, right?
Yeah.
All right. So we could probably bring in $2, I would say, on the covered call in that time frame. So what are we down there? $4?
Yeah,
like $6, $4 to $6, depending on the volatility of that downtrend, right?
You would reduce your cost.
And now you're looking at a stock that is only down $4 to $6, depending on the volatility, right? Mm-hmm. If this was a tech play, it would be down $46.
Yeah.
Like that's the thing. That's the thing that sometimes the scale doesn't show you of these types of plays. Is in these tremendous, horrible, bearish downtrends and everybody's losing their mind. Verizon doesn't care. You cashed your 62 cents on the dividend in the quarter. You wrote 3 months worth of covered calls, and you're now looking at Verizon sitting at a low price instead of a high price, saying, "Well, Buffett just bought it. I'm good."
Yeah, and that's actually was going to be my point. Is it's not a growth stock as Tim said, but you do have that potential to get back up to these highs. And all the while, you're going to collect another dividend coming up soon. You know, you can be writing covered calls and rolling them out depending on your skill set. So you've got a whole bunch of things working in your favor here. And like I said, when you start looking at, you know, one of the things that I did as a financial advisor many years ago was putting together portfolios for people. And so when you start building these portfolios, these are the kind of core positions that I like to look at and say, hey, can I build around this where I can build enough cash flow, you know, with a certain, you know, position size that it's gonna keep that money flowing. And I just think that this is a good setup for exactly that.
Well, but that wasn't my point. My point is you shouldn't even care about the growth of Verizon. That's not why you invest in Verizon. My point is in those tremendous bearish downtrends that Verizon had. It went from 62 to 54, where you captured a dividend, wrote a covered call, and basically you lost $5. You know, in a tremendous bearish downtrend. That was Tim's second pick. Okay. Now, my second pick, Tesla, in a tremendous, I don't think Tesla was my second pick actually, but just to go on the point, Tesla in a downtrend goes from 900 to 540, and you lose $400, $360, whatever it is, right? That's the difference. That's why people love Verizon, and that's why these companies like Verizon, although they don't get a lot of chatter on the message boards. Mark's not going to hear a lot of AT&T and Verizon type chatter on Reddit message boards.
There is no Verizon to the moon.
There's no Verizon to the moon. Okay, that's wrong. They should have a Verizon to the moon over a 40-year compounding gains calculator. We should have that. How can we not get that meme? Like, we need a meme where, like, literally, let me turn on my video for this because this is beautiful. We have a meme, right, to the moon, right? And then you just have over a compounding gains calculator. Maybe we can get those young guys to actually embrace Verizon and dividends. But
I got it right now. Hold on. You got GameStop on a rocket ship that's exploded, and then you got Verizon on
Tesla's
the
Falcon 9. Oh yes, Tesla's Falcon 9. Okay, this is your GameStop retirement account philosophy. This is your old money homes philosophy, right? So I get it, love it, but you invest in Verizon not for the growth. You invest in Verizon for the dividend, right, to covered call, and to never care about it as things go crazy out there. Correct. And just think about anybody out there that's been a part of the Nasdaq. How crazy it's been, Mark, the last 3 weeks.
It's been a ride.
Been a ride. That roller coaster. And again, the difference is very clear. You got on a Six Flag rocket ship and it's volatile versus getting on a Disneyland merry-go-round. Like, that's Verizon.
Mm-hmm.
Yeah, so and I agree with you, Matt, because you kind of made my point there. But you know, you say in this drop you lost $5 after you sold your cover calls and all that. My actual point was that, you know what, you really didn't. On paper, it looks like you might be down $5 if you just wait long enough. You know what I mean? You're going to be back up, kind of like it was, you know, the last 2 times here. So that paper loss could be eroded away. And then as Tim talked about, you start looking at these things longer time frame, you know, the 20-year weekly charts, you can see that pretty much it just, you know, it takes these fits and starts, but it just keeps moving higher. So yeah, that's why I picked it. It's just got that potential.
I like it. So are we voting here? Are we like, how are we judging this?
This is like old men talking about the weather. We just enjoy it. We
sit on the porch.
Yes, we just hang
Can I get my glass of lemonade?
Absolutely.
I need to get a better background. I need to get like a sunny sun coming up background. Anytime old money comes on, we're just a bunch of dudes 80 years old talking about dividends. And
so we're sitting on the porch right now, and some young trader just ran across the
street my porch
and said, "Yo, Boomer, I ain't happy with your 15% returns a year."
And then Greg says, "Yeah, we weren't happy with it when we were your age either."
And then we blew up a trading account.
We blew up. It's like you know what amazes me, guys? It's almost like the people that come out in the market these days, like, yeah, your 15% is just garbage, right? It's like, you guys act like we weren't that dumb one time too.
Yeah, right.
Like you think you have an original thought here? No, To the Moon's been around for a long time.
Yep, in different versions. Absolutely.
Then you throw a
man.
name at those millennials like Peter Lynch. Had the Magellan Fund for 30 years, and his return
Garbage.
was what? His return was like
20% compounded yearly garbage.
Yeah, and it's garbage. I'm like, oh yeah, he's the best in the world at what he does. Yeah, I'll see you again when your account's gone.
Yeah, well, I bought SOS and I made 20% in the last 10 days. I mean, this stuff's easy.
Wait a second. So we go from just being old to being cranky old people.
Listen, I've been waiting my whole life to be a cranky old man.
I love this segment so much. It's just.
Well, I think we had two old money ideas. We can sip the tea around.
Oh man, I'm good. I'm good on Verizon. That's all I need. I got my dividend.
I'll give you one more here. That's probably get a little bit more controversial, but everybody loves candy. So Tootsie Roll's the next one up on this one.
Wait, Tootsie Roll's a stock?
It is.
How did I not know this?
It's an offshoot, I think, from
Wait a
Hershey's.
second.
To be honest with you,
I thought Tootsie Roll with the Hershey's candy.
It used to be. It's an offshoot. It's an offshoot.
Dude,
So,
Hershey's been around for so long. Like,
yeah.
okay.
So anyway, go ahead, Matt.
For some reason, I'm interested in Tootsie Roll right now.
Yeah, so there's a lot to be interested in. Like I said, it's just kind of it's really doesn't do much. So the growth component, just forget that right now. It really doesn't do much unless you get something like this. I don't know what maybe the Wall Street bets.
That was GameStop.
Got hooked on sugar for a week or two or something. But typically you don't see that. And the good news is you really don't have to. Again, the place I always start is I go back to the dividend. Throw the old Tootsie Roll. Like I said, this is an offshoot of Hershey's, I believe. So the dividend is only 1%, not all that impressive. What is impressive, dividend payout ratio is very small, 7 years of consecutive dividend increases. And then you've got your first dividend paid here of 1943. So they're stealing some, history, I guess. But the thing that I like here is even when it says it's only got 7 years of consecutive increases, this is where you dig a little bit deeper and you see this dividend here. So what this was is where one of those dividends in 2012 got thrown into that year and should have been in this year. If you did, you would see that would have been a continuous upswing as well in the dividend payments. So, you've got that history. It's a lower dollar stock. It's got the name behind it. It's a food item, which I absolutely love. And again, like I said, you're not really looking for the movement. The thing just goes sideways. But again, you can just sit there and collect the dividends. And now the pièce de résistance is every year, this thing does a 3% split where you get more shares. So it did it 2020, 2019, so on and so forth. So each year you're collecting just a few more shares just for owning it. So not a bad little gig there. I actually didn't even check the covered calls. I know which is cardinal sin for me. Liquid wise, not really that liquid. So it's just one of those stocks.
But not terrible.
No, not too bad.
It's not horrible, but it's not great either.
It's doable, but it's still kind of gross.
Yeah, it's kind of gross. That's the way I would describe it as well. But for just sitting there holding, you're getting extra shares and you're getting a dividend as well. So really, if you figure out what that 3% split is each year, add that to the dividend, it starts to make it attractive, right? And again, it's something where someone with a little bit of a smaller portfolio, if they're starting to build, $34 per share isn't too bad. So, and again, technically, it is starting to move upwards.
I'm going to ask a value type question, Greg, okay?
Sure.
Do you like Tootsie Rolls?
I don't really eat them, no, but...
I'm a no then.
What's everyone's favorite candy?
That's a good question. But
let me think on that for a second. Listen, you had me at Verizon. I'm
not like
I'm about the Verizon
Tootsie Roll I'm out on. Verizon's good for me though. Greg, do you get any concern when you look at Tootsie? Because part of that storyline was Reddit thought Wall Street was being mean to companies they liked as a child. You think Tootsie got caught up into that nonsense? Because that's a pretty big volatility shift for no reason.
No apparent reason. Yeah, I'm kind of shocked at it. I really am. But
for a company that does pay a dividend, an old company like Hershey and Tootsie Roll and whatnot, it seems like a weird target for Reddit.
Yeah,
100%. But again, I don't know, aren't all their targets kind of weird as far as I'm concerned? Like,
Yeah,
I realize they picked
they are.
GameStop, right? But,
Well,
for me, like I said, so even, you asked me if I like Tootsie Rolls. Well, the thing is they call it Tootsie Roll, but it isn't all that they do. If you looked at
yeah, it's
what I
candy.
pulled up there, it's the, wholesale distribution of candy
Yeah.
and groceries, all that kind of stuff. So like I said, for me, when I start looking at things, it comes down to the product, the fundamental strength of it. Does it pay dividends? Does it reward me for being a shareholder? And then, like I said, if I'm looking for growth, I'm looking for different stocks. But if I'm looking for something that's kind of like clockwork, right? They're paying me. That's where I start to look at this stuff, right? So,
Again, I mean, I don't know how we're playing this game, Tim. I mean, are we interested in Tootsie? Do we say yes or no? I mean, how
There's
do you want to play
several.
the game?
I think. Well, we could do that. I'm going to say, for me personally, there's several things that come into my mind. Number one, I did look up all of the products they sell. Obviously, they don't just make Tootsie Rolls. That's the brand name. That's the one that everybody knows. They make all kinds of different candy, different products, right? Sugar company. The 1% dividend for a value play when I can get a Verizon or some of the others off the dividend fireworks, it would just leave me wanting to choose something else. It's not that I would say I would criticize you, Greg, for owning Tootsie Roll. If that's your choice, your thorough analysis, I'm with you, but I would end up leaning towards other value plays myself personally, right?
yeah, and no issue. Like I said, the thing that I looked at was this extra 3% that they're kicking to you in shares, right? So yeah, you're getting that 1% dividend, but you're also collecting more shares each year. And as long as they maintain that, that does bump it up a little bit, right? So understandable. There's better plays out there, but again, this one here, you don't have to worry other than when the
Sure.
Wall Street people get crazy.
It's
It's not
pretty
going to go
neutral.
up. It's
Yeah.
not going to go up much. It's not going to go down much. Just sit there and get the check sent to you.
I'm still shocked. I didn't know Tootsie Roll was a company. It's been going sideways for 20 years, by the way. If you look at the long-term chart, like give me a 20. This is not a common chart you're going to see in the markets here. Yeah.
Basically nothing for 20 years, but you've got all this. You got all those dividends all the way back to like 06 there. So
yeah, my favorite candy, by the way, Marky, to answer the original question you asked, is the Reese's peanut butter cup. Give me a Reese's any day of the week. That is my go-to. So, Greg, I'm in on Verizon. I'd probably pass on Tootsie Roll, but there's nothing wrong with that. We can't trade them all. We can't pick them all.
That's right.
That's right. Let's move back on the broad markets and let's kind of wrap up our show here today, the ES contract, and kind of get some final thoughts. Obviously, the market's up here on the S&P, 39.48 on the futures contract, kind of hanging around yesterday's price range as well. Let's start with Matt. Matt, final thoughts for the team.
No, had a lot of good thoughts throughout the show. Hope you enjoyed it.
Very good. Marky, what about you? Anything you want to
just same as always, right? Listen, I mean, this market is, there's a reason I'm a long-term bull. There's a reason everyone here is a long-term bull, right? Looking at that. Just be careful. Just be, go the speed limit. Don't have too much leverage, but don't be scared either. Find that fine balance between the two.
Yeah. And I'm with all of that as well. Obviously, we're closing the week tomorrow, so we still got to get price action there. A lot of that will dictate setups going into the weekend. Just like anything, I love the conversation earlier about like tech and what you're doing with it and hedging, because at the end of it, Matt, execute your portfolio design. Be who you are as a trader. Know what your trading plan is, not only on tech, but on energy, on industrials. Just keep doing your job on a daily basis, guys, like every trader needs to do. And, stay at risk averse in general. That's trading 101. But just keep pushing the markets one way or the other, because I do believe stocks are a great place to be over the next 10, 20 years. Greg, final thoughts for you, sir?
Yeah, exercise caution until we get a reason not to, right? We saw that the S&P is kind of sitting at a top here. Is it going to break out to the top side of the bottom? Just wait for it to do what it's got to do and then act accordingly. Same thing we saw in the Nasdaq. Same thing we're seeing pretty much everywhere. Be patient, be cautious, and act accordingly. That's all you can do.
Very good. All right, guys, that's it for today's show. Thursday, we are in the books. We'll be back tomorrow, same time, same station. If you did not catch last night's Trade Masters between young Jake Larmore and Coach Tyler Craig. You can go catch the replay. I believe it was a hotly contested, contest there, Mark. I heard a little rumblings from young Jake. He sent me a few text messages, but if
listen, both of them did a great job. That's all I'm going to say.
yeah, fantastic show. Go catch the replay if you've not done it yet.